I think the story now of higher rates and lower tech is the biggest story in the market. And if we are in a period of higher moving rates, are we going to be in a period of lower moving tech?
Well, we've certainly, it seems like we saw this story earlier in the year. And for, folks who are long tech, such as myself and my team, there are some concerns about the sharply rising 10-year and the potential for that and what that could do to tech stocks. And I think that there's also this backdrop of continued strong economic growth. And so if we're moving into an environment where economic growth is higher, rates are higher, that's not the backdrop where tech did really well in 2018 and 2019. But my caveat there is that with stronger economic growth, stronger enterprise spend, stronger consumer spend, many of these big tech companies, even at the valuations that they're trading at, can still deliver earnings. So I would be cautious over the course of the next 6 to 8 weeks if we continue to see the strength of this rotation away from technology, away from long duration stocks. I still would think about it in terms of what is going to provide me with earnings growth in my portfolio over the next 2 to 3 years. I would contend that we're not going back to a period or going to a period where we're going to continue to see 5.5%, 6% GDP growth. We're going to moderate. We're seeing it in the economic data. And so a cautionary tale that, unloading a lot of your big tech exposure in this short-term period where we certainly may see underperformance, I think is probably not the best decision if you're looking out over a longer-term period of time.
Joe, but it does seem that we might be getting a re-rating for tech that may have already started. You look at month-to-date performance for especially the biggest names, whether it's Apple down 4.5% or Amazon down 3%, and we're going to talk more specifically about that name in just a moment. Facebook has its own issues, down 7.5%. Microsoft and Alphabet are also lower as well. If you continue to see the 10-year move higher in yield, I'm hard-pressed to think that tech is just going to settle in and rise right along with it.
Well, if the 10-year is going to rise, what you're going to see is exactly what was witnessed last week, Scott. The IWM, which is the Russell 2000 ETF, it took in $5.5 billion. It's a $70 billion overall ETF. That $5.5 billion, Scott, that's the largest increase since 2016. So if you're going to see the velocity of the move that we had last week in yields, if you'll see the velocity of moves that we had earlier in the year, then absolutely you're going to see a lot of the cyclical reopening sectors begin to be favored once again. And there's a lot of capital that could flow into that because money has been hiding out in mega cap technology overall, and even healthcare. And I'll point healthcare out because healthcare has been a little bit of a defensive play over the last 6 weeks. Look at the sectors today. Healthcare is down 1.4%. That's the worst sector decline of all the 11 major sectors that we study. So you're correct. We are basically right now, unfortunately, trading the direction of yields.
No, but Shannon paints a picture, Joe, almost like a Tom Lee, where you could have an everything rally. And the activity within the market and perhaps underneath the surface a little bit would suggest that maybe that's not the case, that you're going to go right back to a scenario of higher rates equal lower tech and more money flowing into the epicenter, reopen value, cyclical, economically sensitive stocks. So however you want to characterize it. That happened before. It's going to happen again. This is either or. Either you're going to get an everything rally, you can do that, or it's just going to be back selective again, and you're going to get rotations.
So here's what I think on that. I don't think you're going to get an everything rally, but I think you have to have the everything positioning. I think you want to avoid concentration because if you don't have an everything rally, what you're going to continue to have is rotation within the market in which one strategy or one sector is favored above all. So I'll just give you an example. I hold technology, I hold consumer discretionary, and then I hold financials at an overweight. So I'm kind of in both places. I'm going to let the market work for me, but I don't think at any one given time everything is going to rally. I think it's a continual rotation in performance.